Good morning. Today's Monday, February 25th, and the first chart that we're looking at today is the trade that we put on Friday, which is PPG Industries. If you recall what I spoke about on Friday, the market has made a nice pullback. If you can see up here, the weekly chart is obviously up big time, right? We're pulling back for the first time in a while back to the blue action zone right in here. And on a daily chart, I guess you can say the only negative thing here is that the market has officially broken down through the 50 exponential, which is the hot pink exponential moving average here. But we have broken down into the gray action zone. And my purpose for entering this market was the simple fact that the market, okay, on Friday was able to penetrate up through Thursday's low. Okay, this low, this is Thursday's range, right, from 130.65 down to 128.20. A relatively small bar, right, in terms of range size. And if you look back, it's probably the smallest range that you saw in quite a few bars. And the opening close on Thursday was near the high of the day, which in my opinion is kind of bullish. You should get a move from there. Now, am I telling you that there should be a move back up to this high simply because of this bar? No. But we should be able to reach a level where you're able to at least bring those stops up so you're risking much less than the initial. So if you recall on Friday, what we did here was we went long 20 cents above 130.65. We went long at 130.85. Okay, that's where I'm long, 130.85. The initial stop loss on this was below the low of the bar of entry. The bar of entry's low is 128.20, so 127.95. 127.95 was my initial risk on the trade. So I was risking $2.99 when putting this trade on, okay? First profit objective is 133.93. Look at today. Today's high is 133.78. So we missed it by 15 cents by at least bringing it to even, okay? So I'm not to even right now, okay? But I am exercising some patience here, and my stop has been moved up to below Friday's low. Friday's low is 130.10, so I'm down at 129.90. 129.90 from an initial stop at 127.90. So I'm able to move that risk up a little bit here. So that's where I'm at right now. Now, if you take a look at this, I've moved the stop up to below Friday's low of 129.90, which means my risk now is only 95 cents. So I go from risking $2.99 down to 95 cents, with the first objective being up at 133.93, which is exactly what we were risking. We were risking $2.99, so we took that and we added it to our entry of 130.85, and it gave us a price of 133.93. So right now, I'm risking 95 cents to make $2.99. That's not too bad. That's what is that? 4 to 1? A little over 3 to 1 right now. Okay, so again, a majority of the time, wherever I stick my initial catastrophe stop loss, I'm able to move that stop. So I'm risking anywhere from half to 2/3 that. So that's where I'm at here. Unfortunately, we came real close. If the market had, taken a portion of my trade out at that first objective, honestly, I'd be right up to even now. I wouldn't be risking a dime on it. But again, moving from $2.99 risk to 95-cent risk, in my estimation, is good. So we're still fine with this trade, even though today, again, Monday, February 25th, the market has, opened up higher today initially, and the market's been trading lower ever since. Okay, let me go to the next trade. Remember I also mentioned Yum on Friday, that it was a potential trade setup. I decided not to do anything with this, and the more I thought about this is because the reason I changed my mind is, again, on the daily chart, the daily chart is down. The weekly is up, okay? I typically like to see those in the same direction, okay? So either both up or both down to take a position. Now, if you look back to PPG, they're all green. It's up on the weekly, up on the daily still. So again, Yum decided against that. But A trade I did take today is one of the ones that I highlighted for you on Friday, CRM, Salesforce.com. And again, I'm going to be very honest and transparent with you. This is part of the game. I told you on Friday that I was looking to buy the market if the market was able to take out. Now, let's take a look at this. On a weekly, the trend is up. On the daily, the trend is up. Again, look at the market on a daily. Down here is back at the 50 exponential moving average, right? And what did we create? We created a similar pattern we saw a week or two ago when we took this trade and took 2 of the 3 profit objectives off to the upside there. Same thing, we've got an inside vertical bar, right? An inside pattern. Here, let's blow this up a little bigger for you here. I know I'm posting my videos on YouTube now, and the quality isn't quite as good as they were when they weren't on YouTube, and I do apologize. So I'm going to try to figure out what's going on here. All right, so what I did was I went long this morning. Now the market opened up today at 168.71, traded down a little bit, and then it jammed up through the high of Friday. The high of Friday was 170.56, and I told you I was looking to go long at 170.76. Well, look at the market went up to 170.96, got me long, and my initial stop loss on this, okay, my initial catastrophe stop loss on this was below the low of the inside pattern, okay, very small. The low was 168.75, so my stop was 168.55, and it stopped me out relatively early on, I think within the first 2 hours. So this trade, look at it, if we went long at 170.76 and my stop was 168.55, I lost $2.21 on this. So that was a losing trade. So I want to be upfront with you, okay? It's honest. I'm not just cherry picking the trades here. So that is the trade that I did execute, and it was a losing trade. Now remember, this is an important point to remember. When trading, you need to know where to stop yourself out. The smaller the better, as long as it makes sense. Okay, it's got to make sense. And based on my entries, based on that inside pattern, okay, if it opens up within the range and takes out the high and you're looking to go long, what makes the absolute most sense on a trade like this is to have your stop loss directly below the low of the inside pattern if you want long above it. Because in order for you to get stopped out, the market's got to completely reverse and take out the low, which creates an outside pattern, which in this case would be negative, would be down. Look at, if I had kept this trade, look at where the market's trading now, 165.36. 165.36, $3.20 lower than where I had bought it. So instead of losing $2.21, I'd be down over $5 now on this trade. Okay, so I mean, think about it. You're long a stock of $170 to lose $2.21 is next to nothing. So again, got stopped out on this. It was a losing trade. Walk away from it. Call it quits. Move on to the next. Okay. So again, still long PPG. Again, traded about 132 right now. The CRM trade was a losing trade, and the YUM trade I decided against, because of what the dailies looked in comparison to the weeklies. So it didn't mesh with one another, so I decided against that trade. And so there you have it. And I will talk to you tomorrow. I'll be back with you tomorrow. Have a great day. Bye for now.